Please welcome the panel on Navigating Global Markets, Opportunities, Risks, and Strategies, moderated by global finance correspondent at Bloomberg, Sonali.
Thank you all for being here. They say you're supposed to love all your children equally, but I've got to say alternatives has always been my favorite space to cover, so I'm looking forward to this conversation on navigating markets, especially in the world of private markets. Now, I was thinking a decent place to start off is, Michael, your business invests in many other businesses, and I've seen you do it for many years now, and you have made a lot of changes in your strategy over time. What's in vogue? What are the types of managers you're looking for?
Well, good afternoon, everyone. Pleasure to be on the panel. The thing in vogue today is looking for the firms that are creating the next version of asset management firm. If you think about what we're dealing with today in terms of the overall macroeconomic environment, what it means to raise capital, what you need to have as an organization, you need to start by thinking about what the next gen of your business is going to look like. And we'll talk more about it today, but it has to have a much more global remit. It has to have the type of capabilities to approach the wealth channel, the insurance channel, geographies that really weren't in play just 12 or 18 months ago. So as we think about our firms, we've always thought about the type of firms that do great investing. But at this point in where we think we are in the industry development, it's about who's thinking about the whole business and trying to create the alternative firm of the future.
When you think about the alternative firm of the future, it'll be interesting to see how you see it from an LP's perspective. Andrew, what are the types of managers you're looking for when you're putting money to work?
I think we spend a lot of time focused on managers that we can build lasting relationships with. So someone that is probably introducing new ideas, certainly, but can share intellectual capital with us and not just invest our assets. There are lots of people that are willing to invest our assets, fewer people that are willing to sit down and share intellectual capital with us.
Now, it's interesting, Josh, your firm is about to turn 35. You've operated in credit markets for a long time. When you're thinking about the next frontier, how do you feel that you have to morph Canyon to meet these new opportunities?
You know, we weren't terribly strategic when we started our business. We started out as a hedge fund. It was that era in 1990 when if you built it, they will come, as long as you were a good investor. You could invest the way you wanted to invest, and you didn't really want the LPs telling you how to invest. And if you had smart, accomplished investors in the room, capital would follow. That's completely changed today. You have an entire community of advisors who are advising institutions on exactly where to put capital. You have the retail world, which is a completely different world. You have international investors who didn't really exist on the institutional side. So the investor base has changed, and the markets have changed. And what it's necessitated with us is to think, and by the way, most firms who started that way in our era really aren't around anymore. So the question is, how do we transform our platform to be a modern platform? And not necessarily aspire to be like a Blue Owl or like an Ares or an Apollo or whatever, but how can we continue to provide high value added? And that's meant we'd had to take sort of the club sandwich, if you will, that was the hedge fund, and say some people just want the lettuce, some people just want the turkey, some people just want the bread, and have much more productized types of products. And then also think carefully about the right scale of each one of those so they can still be true alpha generators and not just scale opportunities. So that's required us to develop new products. It's also required us to lower our cost of capital somewhat, because not all products have the types of, you have to have a high cost of capital if you're going to put high fee money to work. And a lot of our products today are lower fee types of products, and they need to have more depth and more higher volume, if you will. So we've had to think about all those types of issues as we've recrafted our firm. And I think Michael hit right on it very well when he was talking about insurance as an example of one type of capital you have to think about. It's quite different from the type of capital that we traditionally would deploy.
So that leads me to Megan. I wanted you to set the whole stage for the type of environment we're walking through right now and what it means for private credit managers that are trying to navigate what could be a slowing economy, maybe even a recession.
So my role at Fitch is I lead the group of analysts that rate non-financial corporates in US and Canada. So our remit is really pretty broad. So within that group, we're looking at everything from AAA rated corporates all the way down to the lowest portion of the rating scale. And the two most obvious ways we interact with issuers that finance themselves in the private credit markets are through our portfolio of ratings on companies that finance themselves in the direct lending markets. And we have also seen, I would say, a growing trend and growing prevalence of some of our investment grade rated companies looking to the private markets as a partnership for some solutions around financing of particularly capital projects around the AI cycle and all this intense investment that you've been seeing there. So we've really been seeing this kind of evolution, I'd say, since the global financial crisis, where from the perspective of the corporate issuers, there's really been this development of this alternative market and place for issuers to go, particularly in times of stress. It has proven to be a bit of a release, a bit of an escape valve for issuers, particularly who have financed themselves in the direct lending market, to be able to tap into that capital in times when we have dislocation in the public credit markets, which, as we all know, can happen fairly frequently and can sometimes happen for reasons that are completely disconnected from the underlying fundamental outlook of the issuers that we're rating. So I would say that overall, the way we've seen the private credit markets move and develop over the last decade or so has been quite constructive for the issuers that we rate in terms of diversifying and increasing the potential pools of capital that they can tap into.
Throughout the course of Milken, there has been a lot of conversation about what kinds of companies will thrive in this environment. Small companies or big companies, domestic companies or international ones. And by and large, a lot of people are more concerned about the smaller companies. And Blue Owl was built off of a series of mergers and acquisitions. You take stakes in other companies. It creates the question of scale, both in terms of how large you need a manager to be and how large you need the opportunities to be for them to invest in. Is it go big or go home these days?
Well, there's certainly an aspect of what we look for that is go big or go home. Our primary focus is on buying stakes in the top 250 firms in the industry, and that's because they have the scale and the wherewithal to be able to create this firm of the future and navigate the type of business environment we're seeing here. But we also have to keep a farm team, a bench of firms that we're keeping an eye on as they continue to progress, because we're positive that the top 250 firms now won't be the same 250 in 3 years and 5 years. So in the GP stakes world, we tend to skew towards the larger end. And for our overall business, which is 60% direct lending at Blue Owl, we also have a scale bias. Certainly as things get more choppy, and quite frankly, we don't see them getting choppy yet. But we're always mindful that they could. Our bias, though, is typically towards service-oriented companies, non-manufacturing, that are quite large and usually have a high degree of recurring revenue. So the whole company at Blue Owl has been positioned towards large, safety, and yield-oriented products for our investors because of this very large and skewed quality bias.
Andrew, how do you think about the way managers show up? There's been a lot of conversation in the last couple of years about how LPs have been consolidating. They want to go to fewer and fewer managers. How do you feel about this dynamic?
I guess that's not something that we've necessarily experienced at Virginia. I think we're looking for the right number of managers. We certainly don't want to create a very expensive private capital index fund. So that's kind of the don't go there line for us. I do, back to my comment about looking for sort of strategic partners, people that can bring multiple unique, interesting products where we can create a relationship that covers multiple asset classes, those are particularly interesting for us as well. But we do also have some small specialist managers. So I guess when you're dealing with $118 billion, you kind of end up with some of a little bit of everything.
Now, Josh, I feel like you have an interesting view of what's going on into the world right now, too. To the extent that you mentioned maybe things are not getting bad yet, where are they getting bad already?
Well, you have to, when you think as an investor, you have to combine both what's going on in the underlying economy and what's going on in the underlying markets that you're serving. If you look at private credit, the part of private credit that has just massively hyperscaled, and certainly Michael and his firm and others have been at the heart of that, has changed. You know, what used to be 675 over LIBOR and 5 times EBITDA is now 425 and it's 7.5 times, and there are no covenants anymore. So we know that doesn't end well. We've seen that. And then how do you keep the same returns to investors? Well, what some people do, because there's just too darn much capital chasing large unit tranches, is, well, let's just leverage what we have a little more to get there. That means you're really not senior debt at the end of the day. You're really junior debt, and you're very leveraged, and you're getting inadequately compensated for that, in my view. So you have to look at what's going on in the capital markets. And when you see that, you say, okay, maybe I won't look there, but what have they left alone that's a little maybe more interesting? And maybe there are things that are more bespoke or a little smaller or a little more complicated that are higher value added, but not as scalable. And are you willing to run a firm that's not quite as scalable? Then you have to combine that with the economy, of course, overall. And where we are in that cycle is difficult to know right now, because we don't really know what the ending chapter is going to be on some of the major issues that people are contemplating, including tariffs. I would say that my own view is there's a high probability that most of the tariff noise will ultimately be worked out in a way that's reasonable, and maybe a way that's a little more favorable, and maybe a little fairer even for the U.S. But along the way, have you shaken consumer confidence to the point where that affects underlying fundamentals? Have you shaken corporate confidence where they don't necessarily want to make the capital expenditures to the point where that affects the economy? Have you shaken counterparties' confidence to the point where they're seeking changes in the supply chain, et cetera? So I think right now, you know, markets have a way of forgetting things that are bad, and so maybe everybody bounces back. And by the way, maybe the markets are down just because they were 10% too high, the equity market. So maybe they're not telling us exactly, they were just looking for a catalyst for that, because they were pretty frothy. So I think it's hard to know where we are. It certainly feels like transitioning from high level of government stimulus to less government stimulus to a world there are going to be more hotspots and more confrontations is one where you have to be a little cautious. And I would add to that caution that there's also the overhang of international issues that can be significantly disruptive to capital markets and significantly disruptive to individual companies that we invest in. We don't know how Taiwan is going to play out. We don't know how the Middle East and Iran is going to play out. But you can certainly imagine a higher probability today maybe than in the past of pretty sharp exogenous jolts to the economy as well. So I think generally the fact that markets are being a little more cautious, and certainly we're being more cautious, I think is probably appropriate.
How do you look across your portfolio companies right now, Michael, and tariff-proof them?
Well, the good news is I don't have to tariff-proof them, and I can't. Their job is to tariff-proof themselves. But look, I think what people sometimes tend to forget about owning either public alternative firms like ours or the GP stakes that we own is that our economics are really not derived all that much from the underlying portfolio. A lot of what we're earning is the continuation of the management fee income and the long-term performance of portfolios. There could and will always be ups and downs that will drive differences in cash flow from carried interest. But a blue owl generates all of its income from fees and really very little from the underlying performance of our funds. And similarly, when we buy into a large firm, they're going to have $100 billion or more sometimes of fee-paying AUM, and they're going to have 5, 6, 7 vintages of products all sort of operating at the same time. And they'll be diversified across many, many different underlying asset types. We have domestic energy, we have private credit, we have infrastructure and buyout and growth. So, there will be impacts from tariffs, of course. We tend to look at the starting point. And if you go back 4 months to January 19th, we were really in quite an accommodating position. If you asked everybody on the street to get out your scorecard of where we sit, you would say, inflation has more or less come down or coming down to the right level. Growth is strong. We have what we hoped was a positive tailwind from the president on the regulatory side. So at least at that moment, things were really, really good. Yes, valuations, to Josh's point, were high, but they were in a place where M&A activity, IPO activity could really take off. So now, it's been one heck of a 4-month window since that point. A lot of headlines and not a lot of actual action. But generally, the managers that we are partnered with are very diversified across a lot of aspects. We have very little underlying manufacturing portfolio companies, and to that extent, very few that do a tremendous amount of cross-border trade. So generally, the private markets, and certainly where we operate in, are much more immune to some of this tariff noise than you would see from large, multinational manufacturing, auto companies, Caterpillar, et cetera. So we tend to feel like we're a second derivative from the tariff issues that are happening in Washington and across the globe.
Megan, how do you parse through all of the impacts across your coverage universe when you have to take that fine-tooth comb and look at how companies are doing and what's on watch right now, given the uncertainty? Where do you get the most concerned?
Yeah, it's a great question. And we, as a rating agency, we really do our work bottoms up, issuer by issuer. But we are starting from kind of a house macro view, right? In terms of where our economists think we're going to be going in terms of the rate cycle, in terms of inflation. I think right now, with respect to, particularly thinking about like the middle market portfolio, the direct lending portfolio, perhaps what's more concerning than tariff exposure is the fact that, right now it seems that the Fed is leaning more towards inflation containment rather than recession prevention. So if we see a delay in that rate easing cycle, those are the kinds of things that can really create stress for the issuers in our portfolio that have capital structures that are highly exposed to floating rate debt. I will say, though, as we've moved through the rate hiking cycle, that we experienced starting in 2022, we haven't really seen defaults in that lower rated part of the portfolio materialize to the extent that we expected. And that's particularly true on the direct lending side, because you do have this sort of unique relationship there between the sponsor, the lender, and the issuer. And where we have companies that are facing a higher cost of capital, but they have a fundamentally intact business model that is not facing, risk of technological obsolescence or some other, really doom and gloom scenario, there's sort of virtuous situation of everyone kind of working together to get that business through to the other side. Now, I think a good question for 2025 as we move into, potentially a slower rate easing cycle, some tariff pressures that create knock-on effects, economic effects, is how long we continue to see that, continue. I think that's a really good question for everyone on the stage. But I think, just thinking about tariff impacts, as Michael said, looking particularly at direct lenders, it's just a less exposed group of companies from a business model perspective. A lot of domestic-focused companies, not a lot of supply chain exposure.
Andrew, do you worry at all about the private markets and the ability to withstand any potential pain in the economy? There's been a lot of talk about the volatility of returns in public markets versus the lack thereof in private markets, but does that mean that there isn't pain there?
I worry about everything, I think. So yeah, that's probably somewhere on the list. I don't think it's particularly high. And I think some of it goes to what Megan just talked about in terms of this relationship between the sponsor and the lender, and it's a more agreeable relationship than perhaps public debt where you're going to end up with lender-on-lender violence, trying to capture what's left. I do worry that an economic slowdown is, of course, going to affect the underlying companies in private markets, but probably not significantly worse than in public markets. So then there's the last part of your question, which I think is the accounting lag masking true volatility? And of course it is. And so we try to look through that when we're doing our risk modeling. I happen to see our risk manager right there. That's where he spends a lot of his time trying to really get his arms around that. Can we do anything about it is another important question, and the answer really is no, right? So the levers that we can pull are really public market levers. What we've committed and invested, what's in the ground at the moment, really is kind of up to the managers that we've hired on the private market side.
It's interesting. There's one thing that a lot of private managers have seemed to be doing in the last couple of years. Josh, I know you're very familiar with this. It's called amend and extend, right? It's that idea of taking on more debt to get through another bridge period, then maybe another bridge period, and then maybe another bridge period. And I think this time around, as we talk to a lot of investors, they're starting to get concerned about how far the can is being kicked down the road. Josh, do you see this dynamic playing? How do you see this dynamic ending, frankly? Because we've seen many periods now of just continual borrowing.
There's a lot more interesting restructurings now that the stock market's come in a bit. Of course, it's coming back. Sponsors want to hang on to these things if they have optionality in their equity, and therefore they want to extend it and they want to take a chance. And if they think they don't have optionality, they're more eager to get rid of it. And I think that, let me give you an example. There's a ton of real estate that was financed in this country in the last 10 years in a lower rate environment. And a lot of that wasn't financed for 30 years or 20 years or 10 years. And some of it's just great product. It might be fully occupied multifamily in Florida or in Arizona or in Texas or places that have net inflow of people and a real lag in terms of new product. And by the way, a lot of new product was developed because rates were low, so there was a bit of a crush of supply. That's about to vaporize. You're not going to see anything. The backlogs are nothing now because the cost of the materials is higher and the cost of debt is higher. Well, those are good products, but unfortunately, a lot of those buildings don't have a balance sheet that's built to last. And if it's one of the masters of the universe who was on the real estate panel the other day, they'll just put in more equity and they'll eventually get bailed out by inflation because they have a real asset that is increasingly scarce as more population comes in and there's a lag in new product. But if you're not that and you're a merchant builder or you have a fund and you spent it all, what do? You don't really want to go to say everybody, well, I bought this thing at a 4 cap, but now caps are 5 or 6. So, that's an opportunity for people like us and others to play a version of that amend and extend game where you make a loan and it's a pay-in-kind second lien loan, and we'll find out in 3 years if they get lucky enough to pay off our 14% or whether we own the building and we own it at a 7 cap instead of a 4 cap. That's a game that's going to take, we've seen a little bit of that, we're going to see more of that because a lot of those financings were not long enough. In the corporate sector, I think we saw a lot of things quoted way down when the market got walloped recently. Spreads were ridiculously tight before, they widened. We didn't necessarily see quite as much trading as we saw quotes, but I also think that a little bit in response to Andrew's comment, I think the creditors are getting tired of this creditor on creditor violence stuff. I find it personally offensive, to be honest with you. It doesn't sort of pass to me the ethical test of what I like to spend my day doing. If I have to defend myself in a credit, we will, but we certainly don't like to be the person initiating some, horrible asymmetric thing that benefits us and hurts everybody else who owns the same security. I just don't think it's right. I think it violates what we used to call, they used to say every contract has an implicit covenant of good faith and fair dealing. That's what they taught us in law school. That's apparently not the case any longer. So I think people are sick of that, and you're going to see a little less of it. You're seeing larger and larger restricted groups, and people just, they're really taking action against that. So will you get more restructurings, less restructurings? There's a lot of unstable balance sheets out there. There always are. It looked like we were in a period where everything was going to have a very bland ending, but with rates ticking back up and maybe things being a little weaker and the market showing a little more volatility, we're definitely seeing an uptick in restructuring supply.
It's interesting. The flip side to this is this idea of opportunistic investing, and we are seeing one fund after another being raised in that space. How much are you seeing that, Michael, and how interested are you in those types of opportunities?
Not very interested, and we try to stay away from that, the kind of, one-time or temporal opportunity that would, that you're referring to, Sonali. But, when you think about what the largest managers in the industry are doing is they're trying to deliver the type of return over cycles that their investors want. I mean, I do think from time to time there are interesting opportunities, but they tend to be small and fleeting. And that this is a very creative industry, and most good opportunities are arbed away quite quickly. So, what we try to do at Blue Owl across $275 billion in assets is find downside protected cash flow strategies that are going to allow people to sleep at night, not just for a quarter, but for a decade. And so, we tend to be perhaps way too calm, way calmer than we should be at times like this. But we've intentionally built these businesses across all of our underlying asset classes to not follow the shiny object, and to build something that truly is giving cash flow back and mitigating risk on a continuous basis, so that we don't have to really run to the next new thing.
Megan, when you think about this dynamic that Josh was talking about between creditors, how do you see that playing out, especially if we see a slowing economy?
Yeah, well, I think, we do hear sort of conversations on lender-on-lender violence in the private credit space, but from our observation, it's really a very different dynamic than what we see in the public markets. What you see in private distress situations is generally the lender, sponsor, and issuer working together, coming forward with some type of quid pro quo transaction where both the lender and the sponsor, give a little bit of concession in order to try to, make that company get to the other side and survive and preserve value. Whereas transactions that are financed in BSL market, it's just a very different environment. You have a relatively large, relatively intractable group of lenders, and I think it, in those cases, you do have opportunity for the issuer and the sponsor to, pit people against each other and come up with these very complicated LMT transactions, which typically result in very complex and layered capital structures, because you're adding layers of debt to that capital structure, and it is very value destructive in bankruptcy, right? Because you're going through this now very complicated, complex workout situation when those credits finally get into a full bankruptcy, in court restructuring. And we have found, looking at, we've looked at research, on, public issuers that have defaulted, that have executed an LMT, and those that haven't, and we do see that it has pulled recovery rates down. We're now down to, if you look at recovery across bankruptcy situations in the public markets, you're looking at about average 40% recovery, sort of across all bankruptcies. And if you look at just the LMT group, it's lower. So.
Now, it's interesting. When people talk about private credit, they so often talk about it as that nearly $2 trillion direct lending market, but then the estimates have gotten much larger in recent years. You have Apollo pinning it at about $40 trillion now, and what they're including is not that traditional direct lending. They're including all sorts of other types of private credit asset classes, asset-based finance, music royalties even. What do you think of that, Andrew? I mean, when you think about the future of how you want to allocate to this industry, what do you prefer?
It's a great question. I think what we prefer is places, all things being equal, places where capital is more efficient. And so if it's more efficient for borrowers to do that in private markets, and it results in higher returns for us, that's kind of a win-win, I think, for everybody. I think we're seeing some of that on the investment-grade private credit side, which is, I think, an area that is probably going to grow pretty substantially, just in the way that private equity has taken away a lot of what would otherwise be publicly traded companies. I think there's a number of different strategies that sort of lean into complexity, and we're actually okay with that, because I think a lot of people are scared by complexity. They're scared by whatever it may be, leverage or fees or things like that. I'm not saying, hey, we love to pay high fees. Don't anybody take that the wrong way. But if we're not having to compete against, CalPERS or somebody for an allocation, we'd rather not. And so if it's complex enough to scare other people away from the opportunity, we probably actually really like it.
It sounds a little like what you like to do.
Yeah, I mean, I just wanted to add to the point about asset-backed, because I think it's one of the most interesting areas today. Part of it is there's huge appetite for the rated parts of asset-backed in the insurance world and elsewhere, but also because the traditional providers of certain services and certain types of credit simply can't provide it because of the capital constraints today. So for example, if you have someone who has a first lien on his house and has a 2.5% 10-year fixed rate mortgage, and it might be 50% loan to value, and a guy might be a prime borrower, that person's very unlikely to move because the next mortgage is going to be 6 or 7%. So, okay, I'm stuck in my house. I need to spend money and fix the floors and add on to it and so they get a home equity loan. These could be 750 FICO score people, but they're still stuck getting a home equity loan. And the people who are in touch with that buyer, the person who's provided the first mortgage, is a bank that can't hold the darn thing anyway because they can't hold any more real estate loans. So there are people who package these things, you buy them, you re-securitize them, and what's nice about them is you have very significant statistical base of what is likely to happen if the economy is horrendous, if the economy is in between, if it's whatever, and we're so far away from a 2008, excess housing stock kind of environment. Pretty good quality product. And the thing about asset-backed is when you're in the public sector, you're talking about public bonds, Megan, and how sometimes versus private, the transactions costs of resolving things can be enormous, right? Enormous. Everybody's fighting, and you have different committees, and the lawyers, you thought lawyer expenses were going down, forget it. The cost of prosecuting a bankruptcy is insane. But the nice thing in the asset-backed area, there's a natural waterfall. You stop, you get less payments. Well, this gets cut off. This guy gets paid down. Now it gets restored. And the savings is really, really material. So I think the market structure itself, who's allowed to make a loan, who has regulations, whose balance sheet is backed up, I think it provides a lot of really interesting and unusual risk-reward opportunities. And they're always shifting. These are not things where you can sit forever and say, I love this business for the next 10 years, because what's attractive today may not be attractive tomorrow. The large cap unitranche business was awesome when it started. It was 675 over, and it was a low multiple of EBITDA, and it had covenants. That's not really the case today. The securitized business is way better today because the people who used to provide that service simply can't do it. And so I think it's hard. I mean, we all like to do what Michael wants to do, which is invest in things so you can sleep at night for the next 3 decades and know that you're going to get your fee streams. But I wish that were life.
Yeah. I mean, we do have half of our business that is direct lending, and you're right, we're not getting 675 over anymore. But, we look at our loan book. Typically, our loans are 40% debt to total value. They're in companies that have over 100 million of EBITDA. And these companies are run by some of the best sponsors in the world that have a tremendous amount of equity at risk. So, that's not a terrible place to be. And we're now operating on a balance sheet. If you take an average BDD or private credit fund, let's call it 1-to-1 leverage. No one in their right mind should sit on a panel like this and criticize the most famous bank CEO of our day, but he always goes on Shanali's show or on TV and talks about how the private credit world's going to blow up. you know, the banking world runs it, you know, many, many more times levered than we do. The mark-to-market requirements in a lot of their books can be quite rapid. You know, we have permanent capital direct lending funds, BDCs, that are levered about 1-to-1 in the types of companies I described. I don't see a catastrophe. We're charging about 9 or 10% a year. Okay, if we have a, you know, what would be historic in recent times, default rate of 5 to 8%, and we only recover half of that, we're still going to be up for the year. So I'm the religious zealot out there, you know, talking in my own book. I get it on private credit, but just because we're not getting 675 over, I don't really lose a ton of sleep at night for the type of businesses that we and others run.
But I do have a question about, you know, Blue Owl did recently buy an asset-backed firm as well, and does this mean this is the future? The future is going somewhere else than the tried and true definition that we have been using for private credit. Is it kind of a recognition in some way that this business may not be the one where the most growth is?
Well, I mean, yes, it's a creation of another asset class that is being stolen from the same CEO I criticized a few seconds ago. So man, if he comes running in the door, I'm going to be in trouble. But you know, when you look at it, banks are not performing these services anymore. There are new pools of capital that are being, you know, grown in size and scale. You don't get even, you know, 450 over in the asset-backed world, but you know, our asset-backed business is lending to, you know, really secure, in most cases, short-term amortizing asset-backed borrowers, and we are able to generate something that is creating a nice spread above the liquid comparable. And so, you know, when we go to Mark Rowan and we go to the sort of insurance businesses across the private capital markets now, you know, we're delivering a really good service. And yeah, that was some sort of highly levered, securitized ABS CLO a few years ago. We're doing it at much lower leverage, but we're still delivering a premium product to our providers. And we think, again, it's a good place to take, you know, the industry has taken a lot of brains from the banking and investment banking world over the last decade and a half, private markets that is. And we've, you know, hopefully, for the most part, in a conservative way, developed a new version of products that will tend to be safer than 9 times levered balance sheets. And we can deliver a premium product to both, you know, our end clients and our borrowers.
Megan, you know, it's an interesting point that you had brought up. You were talking about how much leverage is actually on the investments that you're making. Where are you seeing, Megan, the most amount of leverage? Where are you seeing the pile up?
Yeah, I would say, you know, I completely agree with Michael's comments around the relative strength of the balance sheet of some of the companies we see financed in the direct lending market. You know, typically your highest leverage credits, and I think this historically has been the case and continues to be so, will be your LBOs that with a relatively aggressive sponsor that are financed in the public markets. And I think, you know, there's two aspects of that relative to looking at a company that has financed itself in a direct lending environment. That public market LBO typically is, you know, very highly levered, typically has a smaller equity check behind it than, you know, we would see on the direct lending side. But the other really interesting thing about it is that there's typically some type of momentum with a public LBO credit. Meaning there's a story that's kind of on the come. We're going to do a bunch of strategic M&A, and that's how we're going to grow into the balance sheet. Or we have this aggressive schedule of cost synergies that we're going to be able to realize. And sometimes it works out great. You're in a benign operating environment and everything, you know, sort of falls into place, but oftentimes it doesn't. So I think what we see is more momentum around ratings for those types of issuers than we see in the direct lend portfolio, where really the biggest headwinds to credit there are, as we said, you typically invest in larger direct lend companies, but we do have many in the book that are typically much smaller than something Blue Owl looks at, and you have that lack of scale, lack of diversification diversification, which has proven over cycles to be very protective to credit. So that's really, it's more of a business profile issue than a financial profile issue as the rating constraint.
Andrew, what are the questions that you're asking your managers right now?
Well, we made it 12 minutes without talking about tariffs, so that's probably the longest 12 minutes anybody's gone at this conference. We've had those conversations. Nobody knows anything, right? I think the rest of it is kind of business as usual. So until we get some clarity on that and can figure out how to sort of rethink through the economics of the results of that, I'm not sure we're changing the way that we're investing. So it's, in private markets, what are your edges in sourcing or creating value? How are you going to exit? I mean, we're spending a lot of time on that one right now because there haven't been very many exits.
Right, are you disappointed?
So,
Are you disappointed?
no, sort of on a one-off basis, our liquidity from our private equity portfolio was at an all-time high last year. So, and we've had 4 years of positive cash flow from our private equity portfolio, so full credit to the team that's been able to generate that. At some point, though, the 2021 deals that are all aging and probably have too much leverage and probably got paid too high a price, we're going to have to figure out how to get distributions on that. And I know there's a lot of creative ways to do that. It'd be better if those companies would just kind of grow into the multiples and maybe be sold in a normal process. But I came into this year, I think this is probably the third year in a row where this is the year for private equity. Transaction volume is going to be through the roof. It's going to be great. And my view is probably private equity transactions are pretty much dead for the rest of the year.
Now, we're having this conversation. I very intentionally didn't bring up tariffs, by the way, on this one.
Well done.
We're all navigating a volatile market, tariffs or no tariffs at the moment, and one thing that I'm watching in particular is the 10-year yield. And right now, today, we are at almost 4.4%. It's been drifting higher the last couple of days, despite the general calm we've seen struck from the administration and just shot right into the markets. You still see that yield higher. Josh, what's the implication of this? Because this is not only tariffs, we're going to come up against the backdrop of a fiscal situation in the United States that will change dependent on the course of taxes as well and how the tax bill ends up looking. So rates higher or lower from here, and what are the implications?
It's funny, earlier in the year, I had been for 2 years saying that rates were going to stay higher for longer, and everybody was saying there's going to be 6 cuts and 4 cuts and 3 cuts, and I'm like, why would the Fed rush to cut rates when the market is ripping, unemployment is 0, and there's all this pent-up spending? Save it for when you need it. We may be getting closer to a point when they actually need it. Now, that doesn't necessarily affect the long end of the curve. It might affect the short end of the curve, because one of the reasons why I think the long end of the curve is reacting the way it is people are saying, I'm not, and my argument earlier in the year, like in January, when everybody was finally coming around to higher for longer, I did a piece where on Bloomberg where I was saying I think that rates are more likely to come down. One of the reasons I said is because all of you guys think they're going up. So usually the other side is something at least worth considering. Second of all, you had deregulation, you had DOGE, you had a lot of things that were deflationary. AI is deflationary. Inflation prints were starting to come down, et cetera. I guess now the way I look at it is one of the reasons I think rates have gone up is because we've got one monster amount of federal debt, and we have not figured out how to cut that. And the supply of treasuries is a big number. When you sideline some of the buyers because they're kind of pissed off at you, that's not a help. We had a horrible 3-year auction that we all know about a little while ago. And on top of it, DOGE doesn't appear, at least yet, to be coming anywhere close to the types of numbers that were represented. And I had one of the senior officials who and I won't name who it is, I asked, well, how much is it going to be in DOGE? And he said, well, at least $50 billion. And it was all I could do not to do like the Austin Powers, $50 billion. I mean, like, this is nothing like $2 trillion or $1 trillion. It's a speck, especially given how much the budget has gone up. So I think it would not surprise me at all to see the Fed start to take some action, but I don't know how easy it is for them to affect the 10-year. It's a lot easier to affect short rates, a lot easier. Longer rates are driven by inflation expectations, by how much debt's going to be printed, and all that kind of, these other factors that are more difficult, I think, for the Fed to deal with, and the Treasury, especially when you have ongoing deficits of the size that we have.
Andrew, how is that dynamic likely to affect your portfolio? Because there are a lot of debt instruments that are tied to that longer term interest rate, not that shorter term one that the Fed has more control over.
Yeah, I think one of the places that I have some concerns about a much higher 10-year would be in real estate, where it seems like, we've just kind of stopped the radical repricing that's gone on there. But if everything's sort of priced off of 4.5% 10-year and it goes to 5.5%, which I don't think is out of the realm of possibility, there's another leg down in real estate, and it's probably not pleasant. I think everything has to get repriced to some degree off of that. We didn't see it with the Fed hikes, which I thought was sure to cause, normal finance theory to say, well, the risk-free rate is higher, therefore everything must reprice. It just didn't. The market continued to rip. But I think if it's the 10-year, you end up starting to crowd out some other investment ideas. I mean, our goal is 675, but really it's kind of 375 real. If I start getting opportunities to buy tips at kind of 3 or 3.5, I'm going to have to start taking that pretty seriously.
Megan, and now I'm going to talk about tariffs.
Josh, can I ask a quick?
Yeah, please. Go ahead.
So, Chanel, let me ask Josh and Andrew too. All of you. If you, notwithstanding all of the sort of in-force debt that exists now, if you wanted to just set like the perfect yield curve for looking forward, where would you put it? Where would you put the 10-year, and where would you put the short end? Because of course, everybody, I think, would like to borrow short-term for less than where we are today, but I kind of don't think we're far off of where I would want the yield curve to be.
Yeah. One thing that was, interesting in the rate hiking cycle, particularly for investment grade credit, it was really positive for credit. We saw a lot of companies rein in balance sheets that have become incredibly aggressive post the GFC. So I guess from the credit rating agency seat, if you're thinking about the quality of corporate credit over the longer term, this environment where rates are a little bit higher has been quite constructive.
I try to think about sustainability of the federal balance sheet. What can really last? Are we past the point of no return? Is it, this time it's different? All that kind of stuff. And to me, yeah, rates are part of it. Part of it is just we just can't spend as much.
Right.
And Elon Musk did a panel the other day. He was talking about just how inefficient spending is, and how every individual, when they're working for the federal government, is a lot less efficient than they are if they were the same individuals working in the private sector. And some of the things that are crazy, how much do they add up to? Are they enough to make a difference? Well, somehow or other, the budget was a lot lower in the not too distant past. We almost have to do zero-based budgeting on things and get back to a system that is a bit more sustainable than what it is today. Steve Mnuchin, I think, was very good at trying to look at debt to GDP and keeping those two numbers more or less in parallel, even though the GDP is mostly private and the debt is mostly public, and understanding that sometimes there are exigencies that occur that cause you to have to increase that to take some, but then you got to figure out how to get it back again, and that's the part that we didn't do, and so it concerns me. I'm not sure. What I'm not sure about when you ask about the yield curve is the time frame over which it concerns me. And the reason I say that is the alternatives aren't that attractive. Like you go to, someplace visit a sovereign wealth fund and say, well, we're thinking of putting more money in Europe. Okay, you have a collection of high tax prone, high regulatory prone. They're almost like internally tariffing themselves because of the way they structure themselves. Countries that had a 1.86% growth rate to their stock market the last 20 years versus 10% in the US. And they're all fighting each other. Okay, I understand. Germany's going to spend more money on defense, but do you really want to put a huge percentage of your assets there? Well, maybe China. Do you really want to put a huge percentage of your assets there if you're a global asset allocator? We're all a little more domestic in our thinking, you know. But I don't think we're at a point where the alternatives are terribly viable. But I almost think that puts an extra burden on us to be responsible to defend that position, and I don't really think we're doing that very well.
I think the other important question is, who does the yield curve look good for, right? Because one question I have is, to the extent that you're worried about the fiscal situation of the United States, it's more expensive to finance the U.S. debt load at 4.5 than it is at 4 or even 3.5. And at what point does that become a problem for all of you?
No, without a doubt, sort of the continuing growth in U.S. debt and the requirement for refinancing, you know, sort of gets problematic, and it's, you know, it's razor thin in terms of moves. But in terms of the economy and where we stand domestically, you know, being able to, you know, look at a 4.3 10-year is still below the average over the last 50 years. So, you know, I chuckle. I'm guilty of saying higher for longer all the time, but it's sort of like that's probably not the right way to describe it. It's, you know, not as high as it usually is, but higher than it has been recently for a little bit longer. That's a mouthful. That's why no one says it. But kind of where we are.
Okay, so I have a question from the audience now as well. Toss up for who would like to take it. Isn't the main issue for private credit, specifically BDCs, valuations? When externally, usually with strong influence from funds, the marks determine NAV, which dictates stock performance, and the fees generated by the manager, GP, valuations typically lag 1 to 2 quarters, which can mask some pain for some time. Then you factor in potential NAV lending at the fund level or internal capital markets, BDCs max leverage at 2 to 1. Could there be can kicking from the borrower all the way up to the GP? Would you like to take a BDC question over there?
That aimed at me since I've been so bullish on our portfolio. Look, I think yes, that's a great question, and all comes down to valuation, because I maybe too cleverly pitched my my portfolio attributes based on debt to value. Now the question is, what's value? If we or the underlying GP are making up value and saying, look, this company is worth 22 times, and look, we're only levered 40% of that, well, that could be really bad if the valuation should be half. You know, we do believe in private credit, you got a long way to fall from 20 to 60% of 22 times is a long way to go before the private credit market gets hurt. And boy, your equity portfolio, whatever GP on the equity side you gave your capital to, just got wiped out well before we do. So, you know, that certainly would be bad for the GP stake side of my brain. But for the private credit side, you know, it is all about valuations, and that's why we care so much about it. And that's probably a driver as to why activity is certainly muted compared to what we hoped for. But I guess, on the one hand, I say, yes, it's heavily dependent on valuation. On the other hand, I say 60% is a long way to fall in most of these mechanisms.
Megan, what are your scenarios here? What is kind of the highest end in terms of where you see rates going from here, and the lowest end depending on where we are on tariffs and where we are on taxation and the rest of Trump's agenda?
Yeah, it's a great question. Generally speaking, sort of the view from the top of the house and the macro is that rates will drift lower very slowly, right? And I think from our perspective, though, in the seats that we sit in, we love to stress test the portfolio. One of our favorite activities. So we'll routinely, pick a sort of outlandish interest rate scenario and run just, that test across our entire portfolio of, say, B+ and below rated credits. And we will match that up with credits that have the lowest headroom under their existing rating sensitivities. And then think, critically about whether those are companies we want to have a conversation with them about what their plan would be if we're going to be in a consistently higher rate environment, and or do we want to hold a rating committee on that company. So those are the kinds of scenario analyses that we're constantly doing. So for us, it's less about picking a point, a destination in terms of rates, and more about thinking about what does a worst case scenario maybe look like, and then how would all of our issuers perform under it.
Dare I ask, what is your worst case scenario?
I think at one point we had modeled around like a 12% scenario for the greatest part of like our book of business in the B+ and below rated category at the start of the rate hiking cycle, and that proved not to be all that conservative. So we recently went back and did it with a little bit of a higher one, just to, stress test further, but it's a constant exercise.
So with the remaining time left, we only have a few minutes left. I want to ask each of you for your biggest risk and your biggest opportunity as you're going through the year.
I think you have to be careful about exogenous risks that can affect the capital markets in a really big way and sort of change the mood of investors. Remember, we started from this point where Trump got into office and gave a great advertisement for why you should give all your money to the United States of America. We're going to be deregulated and lower taxes and all these wonderful things. And then we had the tariff narrative, which sort of interrupted that. But I think that my guess is that we work our way through the tariff stuff. It'll take time, and we'll have a little bit of collateral damage from the reasons we talked about earlier in terms of people's mood. But I think a significant change in a place like Taiwan, I think the market doesn't discount adequately. I think the same thing's probably true with respect to Iran. I think there are other hot spots as well. I think the nature of global dialogue is such that these things always happen when you least expect them, and they really can rock the market. So I'd say that's kind of, in some respects, the biggest risk to capital markets generally. It'll affect all the capital markets because these are the kind of things where everything gets correlated because everyone's mood sinks.
Biggest risk, biggest opportunity.
Biggest risk, I think, is that the economy is slowing way more than we think right now. We're definitely seeing that in sentiment numbers. We haven't started to see it in any of the hard data, but if it shows up, I think that puts the Fed in a very difficult spot, trying to decide whether to cut rates to help the economy or to deal with what is likely to be, non-trivial amounts of inflation thanks to tariffs. Biggest opportunity, well-struck trade deals, maybe, but I still don't, I'm not sure I'm not losing sleep about a big rip up in the market, I guess, at the moment. I didn't answer the opportunity part, but to me, one of the biggest opportunities is that the regulatory framework around banks and the balance sheets of banks is so difficult and it's so impossible that on the one hand, it creates this whole private credit opportunity, but they also don't always like all the business going to people that show up ahead of them in the league tables. So at least for people like us, what gets us really excited is places where, major money center banks will send us really easy real estate loans where they'll get, a crazy capital charge, like 100% capital reserve requirement, and it's not a difficult loan, and then provide us back leverage at a super low yield because that doesn't count as a real estate loan. And so then we're leveraging ourselves into a 15% yield, but they might not show that to some of the people who they think might otherwise compete them out of existence. So for the moment at least, then the same thing's true in asset-backed. I think the regulatory environment, it's tough to be a bank, even if you have a really good balance sheet. The web of regulations is enormous, and I think it presents big opportunities when you combine it with the cluttered up balance sheet that they have from making low yield, long duration loans in the past.
It sounds like you were talking about Michael's favorite banker over there for a moment.
Might just be.
Megan, risk, opportunity.
Well, I think from the perspective of corporate credit, the biggest risk we probably see right now is a prolonged stagflationary scenario, right? Like the effect of tariffs is really the worst that we fear, and we start to see the consumer weaken because the consumer going from strength to strength has really been what's supported corporate credit over the past 4 or 5 years. I guess on the opportunity side, I think if things turn out to be, hopefully a better result in terms of what we see with the whole package around tariffs, and perhaps we see something on tax reform, there are companies who have balance sheets in relatively good shape. If we do see sort of a restart in the transaction environment and see some more strategic M&A, I think that could be interesting.
And the last word.
Shelley, I'm only going to go with the risk because I go to bed every night sick to my stomach. I worry about one thing. It plagues me. I get up worrying about it, and that's that the Steelers are going to enter Week 1 without a quarterback. And we have absolutely no clue what we're going to do.
I knew you were going to go there somehow.
Screwed. So anyhow, that'll be my answer.
Oh, well, leave it at that. Thank you all so much for your time today. What an amazing topic at this point in time in this economy, and thank you all so much for having us.
Thank you.